following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call the old Options Insider Radio Network. Let me mention right here at the top, if you haven't had a chance, check out our latest addition to the network, the Futures Options Roundtable. I think you're going to like it, particularly if you're a fan of the Option Block. You can find it in all the usual places on theoptionsinsider.com, iTunes, Stitcher, Aha Mobile, wherever you get your podcasts. If you can't find it there, let us know. We'll give you the RSS feed. We'll get it set up however you want to listen to it. But check it out. The first episode went out, I believe, a little over a week ago. It already is tearing up the charts in iTunes. Episode number 2 will be coming to you very shortly. Maybe even by the time you hear this episode, that episode will be live as well. So check it out. The Futures Options Roundtable. I think you're going to like it. And speaking of roundtables, we got a great one in store for you today on the old all-star panel, starting off with the man of all the funky hats over there at OX. You know him, you love him as the Viceroy, a.k.a. Alex Jacobson, the educational major domo over there at Options Express. Alex, welcome back to the show, sir.
Hey, Mark, good to be here today.
Yeah, it's a good day to be here. Good, a lot of some action actually to talk about, including some additional downtrends towards the end of the day. But we'll get to that momentarily. But first, let me introduce our other cohorts on the old panel. Starting off with yet another appearance on the old show. This must be some sort of record. We are joined by good old Mark Sebastian, the director of education over there at OptionPit.com. Mr. Seabass, welcome back to the program, sir.
Hey, no, I'm now the founder emeritus of OptionPit.com. That is my official role.
Founder emeritus.
Director of Education to Andrew.
Ah, founder emeritus. So you have moved on to bigger and better things. You're now in the realm of academia.
That's correct. That's correct. I'm one step shy of major domo.
You are the assistant professor of home economics over there at the Chicago Community College. Is that your new career path you're telling us?
Yeah, that's exactly correct. How did you know?
I saw your LinkedIn update. All right, and last but certainly not least, beaming in from the great city/town/principality known as St. Charles, Illinois, he is good old Uncle Mike Tusaw from RCM Asset Management. Uncle Mike, welcome back to the show, sir.
Always happy to be here, and you'll be happy to know that I have been promoted to head flunky here at RCM, hoping to one day make the assistant lackey position.
Wow, this is just LinkedIn updates across the board for the entire panel. So listeners, if you haven't found everyone yet on LinkedIn to follow all their updates, then do so. So you can keep track of Mark's community college positions and Mike's flunky positions. A lot of good stuff going on. All right. And with the team assembled and most of their positions relatively secure, we're going to keep on rolling right on into the trading block.
The trading block.
All right, everybody, welcome to the Trading Block. You know what those bells mean. They mean it is time to break down the interesting action on the old street today, and it was indeed a bit of an interesting one. We started off the day down, trending downward in most of the major markets, and we had some developments towards the middle of the session that seemed to just weigh on everybody's collective consciousness because the markets just took it off to the downside and never really looked back. The S&P closing down nearly a full percentage point to 1676. The NASDAQ closing down indeed a full percentage point, or 37 handles, to 3770. And the good old Dow closing down nearly a full point as well to 14936. Oh, lest I forget the people who wrote in asking for the dates. We are recording this on Monday, October 7th, and you're listening to this on Tuesday, October 8th, or perhaps beyond. So bear that in mind when we're giving you market updates here. And of course, Vol is just off and running today. VIX Cash has been ticking up since we started recording the show, continues to tick up, closing up about 2.6 points on the day to 19.33. Perhaps we'll start there, because that seems to be the more interesting narrative coming out of today's sessions. Listeners, you'll remember about exactly a week ago, right, going into the teeth of the shutdown, we talked about how everyone was loading up on near-term downside in SPY and SPX right around the 1680 level or so, and then turning around and taking all that juice that they were bidding up in the S and selling it in the upside in the VIX. Of course, what happened, is that VIX just took off to the races, and as we mentioned before, it's kind of hard to get that back sometimes once you've written that. That seems to be perhaps the case we're seeing play out today and in some recent sessions as VIX just continues these upside movements. People are scrambling to get some of these short calls back. Is that what you're seeing out there as well, Senor Sebastian?
It was an incredible short squeeze. I mean, in the move that we made in the last hour, 40 minutes of the day, from going from about 19.6 to 18.6 to about 19.4, happened quickly on little to no movement in the S&Ps. I mean, it was incredible how quickly we moved.
It continues to tick up. Since we started the show, it's ticked up about 0.2 of a point as well. So the vol continues to creep into the marketplace. And it looks like, it certainly does look like this is related to the aggressive, perhaps somewhat over-aggressive VIX upside selling we saw going last week. We commented at the time it seemed a tad aggressive given the marketplace, and that seems to be the case.
I mean, it's really incredible, the movement we've got. And, the entire curve in the S&P 500 got just completely jacked today. They really ran vols up kind of across the board. And, what I think we're setting up for tomorrow is some sort of, now that the VIX is basically sitting at 20, I wouldn't be shocked if we walked in tomorrow and the S&Ps were down 15, 20 points and the VIX wasn't even moving. They've now got this to levels that they've got these to a relative, at least with still 10 days to go, they've got the VIX at what I would call relatively consistent levels with, something bad can happen. If we start getting to 20, 21, 22, 23, I'm going to officially ding the way overbought bell. But, man, this was an incredible move, and it looked a lot like people racing to cover.
Yeah, it has all the hallmarks of a short squeeze, and we see these all the time, and including in vol. You can get a short squeeze in vol very easily.
Yeah, a lot of people don't realize that. You really can. And you're sitting there watching it, and I guarantee you, this is the mindset of everybody watching this. This is a total short squeeze. This is ridiculous. I can't believe how high the VIX is. It makes no sense. I'm going to buy back half my position anyway.
We talk a lot about pricing tail risk into the marketplace and whether that's overpriced or underpriced. You hear less back and forth about the premium, built into things like VIX upside and if it merits, or if it merits selling in these kind of environments, or if it's not priced in adequately enough, given the extreme rapidity of the movements we see out there in VIX. I'm sure a lot of people out there right now probably asking themselves that same question. Is what I sold last week, was that worth it at all to get run over like this? And I'm guessing a lot of them, maybe their answer is different this week than it was last week. Tends to be the case when you get run over, particularly to the upside. Mr. Alex, you mentioned before the show there you're keeping an eye on some interesting activity that caught your eye out there in fixed income land, sir. What was it in particular that really caught your eye there?
Yeah, I know it's not our core listener, but the futures guys today, when I sort of pulled the futures desk on what was going on, they said obviously VIX was keeping them busy, but they said the curious thing they noted was in the T-bill cash market, bills maturing after the 17th, after the potential drop dead day for the expansion of the debt limit. Bills maturing after the 17th, there seemed to be some aggressive selling, so much so that the short bills were yielding more than the 90-day bills going out. So it's clear that people are believing that this is real, and it could certainly last past the 17th. And the futures guys don't want to use the word panic selling, but there was aggressive activity going on in the bill market today.
Who was that guy that started talking midday that really spooked the markets? The Republicans in Congress are basically arguing that we can go over the 17th and not default, and that certainly spooked the markets out. Real interesting, but that's just incredible. If that's what they think, and nothing like that. I feel like both sides though are kind of cheerleading the market to sell off so that it can force. They each think it's going to force the other one to make a move. That's kind of my interpretation.
Yeah. So Washington is playing chicken with our lives. That's a joy. I mean, last week you had the president trying to talk the market down, thinking it would have an impact. That's clearly someone who never has to run for election again.
Yeah, you tend not to see that in first terms for a president.
Right.
Yeah, exactly. And even if you look at the vol moves today, I mean, just under 1% in the market is about a 14 and a half vol realized today. VIX today is over a 200 vol. So we have a client here who calls me periodically, and he has this VIX to S&P ratio, and he pointed out that lately the VIX has been moving less than 10 times the S&P. The S&P today had a realized vol of about 14.5%. VIX has a realized vol today of over 200%. So clearly more than 10 to 1, actually 16 or 17 to 1. So it looked like there was some panic buying. And again, I have to cautiously use the term panic buying, but 16 or 17 to 1 means people were going out to grab vol today. So kind of an interesting day, both from kind of a quantitative standpoint and both from a trading standpoint, because what you saw today is even the usual suspects, the Apples, the Facebooks, there wasn't a lot of volume in them today. Today it was really kind of macro. People looking at the spiders, people looking at the S&P, people looking at VIX, and the ironic move in the cash T-bill market.
We joke about this a lot on our other show, Volatility Views, which should be returning to a podcast provider to you very shortly, about just the basic math that goes into vol trading, how easily people forget. You're talking about about a 200% there vol move or VIX level. Mark was just talking about how we're already pricing in panic levels, and this is just on the heels. We just got out of Q3 and just crunching the numbers for Q3. S&P was moving less than 0.5% a day, about 0.45% a day. That's the lowest actual realized vol we've seen since about 2006, so nearly 7 years. So how quickly the frame of reference is lost, how quickly the panic sets in. Clearly we have some mitigating circumstances going on right now, but unless unless it's earth shattering, unless we do indeed fail to meet our obligations here and we do shut down, which is certainly a possibility. This stuff's going to come crashing back to earth. It kind of has to, very, very much in the near term. Otherwise, all hell is certainly going to break loose if these vol levels are merited going forward. Now, Mr. Tusaw, what was catching your eye? What was moving your own needle out there in RCM land today?
Well, what was moving my needle is that my needle wasn't being moved that much. I really didn't have a lot to do today. I was kind of disappointed. I thought I could make some fun adjustments and do some things, but it was kind of a boring day, and in a market move this much. Apple actually went up a little bit today, so I closed out of a short put spread that I'm doing as a means of financing a longer term put, protective put. And on my diagonal spread on SPY, with the vol going up so much and the market going down so much, it's weird in that I think this just goes to show we talk about the 6 month, 1 month, or one month ratio in terms of doing a collar, and I kind of have a similar position set up with this diagonal spread in that I'm long the SPY March 160 calls, and I'm short the front week 169 calls, and I've been adjusting this spread now for a little over a week, and the market's down from 169.25 approximately from where I got into this spread, and I'm actually break even on this trade right now, and I've only done 2 adjustments to it. The main reason for it is that volatility's gone up so much as the market's gone down.
The market is doing your adjustments for you, sir. You can just take an extra BBI today, I think.
I think I can just go home now. It doesn't matter. I'm just gonna go play golf or something. I don't know.
Just like the rest of those advisors out there, just buy some SPY, buy some T-bills, and go play golf. Here you go. You're done.
I gotta sell some load annuities too.
Oh yes, that's true. I forgot the annuity component. Then you're done. Then you're out by like 10 as opposed to 9:30, and then you go play golf. Then you're done.
There you go.
Of course, there were some other developments in the realm of finance, particularly beyond the macro stuff, particularly relevant to some of us here in Chicagoland. Good old Potbelly finally going public and having a little bit of an upside. Let's see where they closed today. Up about nearly 6% to close at $32.40. This could potentially be the next big IPO, next big option trading name. Alex, I know there's a lot of local clientele floating around over there at OX. Any love for this name? Any interest? Any people calling up say, hey, when's it optionable? Or are they just kind of play and wait and see?
Nothing on the phones. The interesting thing is our former CEO here before he came here came from Potbelly. I can tell you I'm a large consumer of their milkshakes, but there were not a lot of calls asking about it today.
And not many people know this, but you can order a cheeseburger at Potbelly. That's a secret thing that not many people know, but you can order one, and it's not on the menu, but they will make it for you if you ask for it.
I think you're telling us tales, sir.
It is the truth.
Yeah, the value of the information on this show has just quadrupled.
Everyone's going to be running into to their local Potbellies, ordering cheeseburgers. Because you want a quality burger, Potbelly is where you go.
Back when I was at OX and Fisher was there, I'm not sure if he leaked that, but no one believed it then. But we sent someone to order a cheeseburger there, and they knew what to do. They got us a cheeseburger.
That's like saying you can go to.
Was it any good?
Yeah, not really.
That's like saying you can go to Gibson's and get sushi if you want. It's off the menu, and then maybe they'll make it for you. But I don't know if you really want to do it. Or if
I'd prefer the Sebastian Special, the greasy meatball sandwich.
There you go.
And some of the other hot button names we've been talking about a lot lately. Of course, Tesla making back all of those, pretty much all of those post-fire sell-offs. All the bears seem to have retreated yet again because, God forbid, Tesla actually sell off for 2 sessions in a row. So Tesla making back to the retracing back well over the 180 level, and all the love. All is right with the world again in the world of electric cars. So a lot of interesting stuff ticking around out here today. All right, and that is going to do it for the old trading block, and now we're going to keep on rolling right on into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
All right, and welcome to the Odd Block. This is, of course, the portion of the program where we break down the interesting and or the unusual, and sometimes just old downright bizarre trades that are lighting up the old tape today. And we're going to kick things off with a name we haven't talked about in the Odd Block in quite a while. This is eBay everyone's favorite purveyor of mostly used goods, doing about, I'd say about 25,000 contracts a day of late, which is probably a little bit inflated for them, and doing about 20,000 today. So a little bit less from a overall ADV perspective, but from a one-strike-fits-all kind of day, this certainly falls into that category. Well over a quarter of that volume, all going up on one strike. One looks like a massive covered call sale. We saw the D62 halves going up, being sold 5,640 times for 62 cents. This is on a strike with some open interest of just 81 contracts. So this is all open in paper, and it looks like this went up on a big block, which has institutional written all over it, and also hit the bid, so someone not really finessing the trade that much. This has all the hallmarks of an institutional covered call sale. Someone coming in saying, "Hey, I don't mind taking off eBay if it rallies another 8 handles," and also getting paid 62 cents to do it. Not a bad trade overall. Uncle Mike, any of your clients play around in eBay at all? What do you think of this covered call trade here?
My wife plays around in it more than I care to. But, covered calls are tough right now in this environment because of the fact that just in general we have a higher vol level. And with the market down like it is, I'm not sure if I'm much of a covered call fan in this market environment. What I would be a fan of would be either a deep in the money type of covered call, or something along the lines of short put to get into something if you don't mind, if you think it could have some further downside, if that makes sense.
Yeah, we talked about that in one of our other programs recently, the options boot camp, and just the different ways you can migrate your liquidity in a covered call, particularly in this environment where, the last few days, notwithstanding this crazy vol pop we've had, but outside of that, the general trend in vol has been stagnant to down, and finding ways to juice those returns. And a lot of people are doing exactly what you're suggesting. They're migrating their liquidity essentially into those deep in the money covered calls, trying to take advantage of that vol pop they're getting from trading in the put wing. Of course, a lot of other advantages and disadvantages associated with that. This guy taking the more traditional route of selling the old out-of-the-money calls in eBay. And if eBay rallies 62.5, I'm guessing he's not too upset with letting the stock go there. Not a bad level at all. So an interesting, relatively straightforward, but still, if you're looking for covered calls, maybe a name you might want to consider here. Good old eBay. Next up, we have a newcomer to the odd block. This is Dex Media Inc., ticker symbol DXM, because apparently Dex was already taken. They closed today at $6.93, down about 30 cents on the day, so a bit of a sell-off here in good old Dex. This is a pretty light one. They do about 400 contracts a day, but today they lit up the paper with some weird paper, which is why we call it the odd block. We saw someone coming in today just lighting up a bunch of strikes. They did, about 6,500 contracts today, which is a ton for DXM. We saw someone coming in today and starting it off selling 3,000 of the Dex 7.5 calls. These are in December, so the December 7.5 calls for, I have net prices here. And then they bought 1,000 of the Nov 10 calls, 1,000 of the Dees 12 halves, and 1,000 of the Dees 15s for about a 30 cents net credit on the day. Looks kind of funky when you look at it at first. Looks like some kind of weird time stupid almost with our time ratio spread. But it actually, when you start looking at the open interest, there's only 300 open on the D7 half call, so that's clearly an opening sale there. And then there's about 1,500 open on each of the rest of the strikes. So those appear to be closing. So it looks like someone was pretty aggressive out there, selling some upside out there on the Nov 10s, and then also getting out there to the Dees 12 halves and Dees 15s. So aggressive from a volume perspective, perhaps not from a strike perspective, pretty far out of the money calls. And now they're closing those out and rolling down to some meteor calls, getting a little bit more aggressive and trying to pick up a little bit more premium. Maybe they're also underlying holders and they're giving up the ghost, saying, heck, we're not hitting any of those strikes anytime soon, so let's get out here on the 7.5 level. Not exactly a stupid Uncle Mike, but still got some interesting around the way volume here for you. Maybe something you could keep an eye on this one and discuss it down the road when you eventually do get to that Trading with Stupids webinar you promised me for so many years now.
I want to keep building it up. It's not the right moment to have it. It's just not right yet. I need the right everything, and we're not there.
I don't know, the market hitting exaggerated levels from a vol perspective, people selling vol and scrambling to cover it back. That could qualify as stupid in some people's books. So maybe we are there. Who knows?
Nah, not for the stupid webinar that I want to do, by gosh.
All right, next up we have another newcomer to the old odd block. This is MILL, ticker symbol MILL. This stands for Miller Energy Resources, Inc. Another a little pricey for an odd block special, $8.12, but still one of the cheaper names we like to talk about here. Trading about 500 some odd contracts a day on average, doing about 3x that today, and pretty much all of that, most of that coming in one pretty substantial in the money put buy actually. So this was a buy, opening buy here. We saw the Feb 2014 $10 puts. So these are about $2 in the money puts now. Trading for about $2.50 or so, about 1,300 times. There's no open interest to speak of, so this is all pretty much opening paper. And went up pretty much in some mid-sized blocks, lifting the offer eventually. And it looks like it's all opening paper, which, if that's the case, I'm trying to think back. This is probably, we always talk about out-of-the-money call buys all the time. Deep in the money put buys, this may be a first for the odd block. We've had people buying near and around in the money puts, but these are roughly two-handle in the money puts. Mr. Tusaw, what's your take on this strategy, the kind of flipping the script a little bit? Maybe you have a stock that's retraced a little bit, and so you buy a $2 in the money put to protect it. What's your take here? Maybe this should go in the old stupid webinar.
Well, that, or maybe he's trying to create a simulated short position, just because of the fact that maybe he doesn't want to be short that much premium or many stock shares, and is not a fan of trying to play vol or things like that. He just wants to create as close as he can, or she, you never know, to what a short stock position would be. That's the only thing that I could come up with if you're buying a deep in the money put.
Yeah, that's a bit of an odd one. Of course, synthetics, we're talking at, out of the money calls yet again. So it does fit the bill of what we usually talk about here on the show. It's just an odd way, a very capital intensive way to go about it that we don't really see very often. This one might qualify for some future watching. I think we're going to put this in the to be studied trade.
Yeah, because usually if you're bearish on something, in my experience, whenever I've done bearish trades, I'm fine paying a little bit for the juice on the puts, because if I'm bearish on something, I think it's going to go right now. And so if I'm wrong, I'll just get out fairly quickly. So typically I don't buy deep in the money puts for bearish stock positions.
Yeah, that's an odd play. I think definitely worth evaluating, see what happens in MILL. Maybe this thing takes off to the downside. This could be not a terrible trade. It's an odd way to go about it, but I can certainly perhaps see why he may be taking this approach. An interesting one nonetheless, and I think a good one for us to leave the listeners with today, because there is so much to mull on that one. Of course, by the time you guys hear this tomorrow, maybe you'll see some more going on in MILL, and this trade will make sense. So keep an eye on this one. We will file it in the TBD portion of the show to check back on maybe in, let's say we got some time. These are Feb 2014s, so we got a few months to check back on these and see how they work out. In the meantime, we're going to keep on rolling right on into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, listeners, you know this portion of the show. You love it. It's the portion of the show where Alex dons yet another of his fancy Viceroy caps and takes the reins and gives us the guided behind-the-scenes tour of Options Express HQ. Mr. Viceroy, what was cooking? What was going on? What was catching your eye over there in the land of OX today?
So individual stock names were quiet, and even the usual suspects, the Apples, the Facebooks, were not really lighting up the phones a lot. Today it was VIX, and then it was more VIX. A lot of SPX, as I mentioned before, we're a big SPX shop here. But it looked like most of the activity today was either in the indexes or in the vol products. A little bit of Tesla, and I know you mentioned Tesla earlier, Mark. There is still a whole cadre of people who are non-believers in Tesla, who kind of crawl out of the woodwork every time it has a bad day, and you know, I hate to say that they are looking for it to get crushed, but there are a lot of people like that on our social site. Every time it goes down, all of a sudden it lights up with "I told you so," and so it sounds like there's still a lot of people out there short or pessimistic on Tesla, and they did not do well today. But the overall today, everybody was looking at Washington. Everybody was looking at rates. The dollar, people think this shutdown is real, and that's what drove a lot of trading today. And every time the market kind of tried to poke its head up and do a little better, it just got hammered back down.
I'm looking here at the trading patterns tool while you're talking about Tesla, and it certainly does appear to be in that, let's say, in the sexy area, in the high-flying names area, because everyone over at OX who's trading Tesla, the number one name they're trading is Facebook, and you probably can just rattle it off the top of your head. The other names they're also trading because they're all the other sexy de rigueur type names like Apple or Netflix, and then JCPenney, a very not a sexy perhaps brand these days, but a sexy name from a trading perspective, that's for sure. And then LinkedIn, Solar City, and you're kind of going down. I think the gold COMEX at number 8 is kind of interesting. The big Dees future over there at COMEX for gold, kind of interesting seeing that one popping in, and then a couple others, Dry Ships and Himax Technology. So people trading Tesla. I won't say they're surface type traders, but they seem to be moving from one hot thing to the next with a great deal of regularity. Speaking of moving from one hot thing to the next over at OX, I know, Alex, in general, the audience at OX tends to lean towards the premium selling side of the equation. And recently, of course, given everything we talked about here with the movements and how perhaps dangerous it was to be aggressively short gamma going into all this just vol exploding and the market have so much uncertainty right now. Are you seeing, talking to the guys on the desks, are you seeing people perhaps, are they starting to keep their powder dry at OX? Are they perhaps maybe adjusting and doing some smaller size trades or moving to less volatile names? What are they doing over there to reflect the changes that are going on right now?
The hardcore premium sellers tend to adjust in this market. It takes a while for them to kind of pull back. And if you think about it, if you look at the SPX, which is really the instrument of choice, its range has not been that dramatic. I mean, we kind of look at this every couple days for the show, but, you're looking at a market that's kind of back where it was, a week ago. And you got a lot of folks up here who sell 1 or 1.5 standard deviations out. Some of them selling a half standard deviation out. You haven't really hit those numbers yet, unless you were selling premiums in the weeklies. You've had opportunity to adjust here. The vol pop has probably hurt you more than the actual move in the SPX if you were a premium seller, but more adjusting than any sign of capitulation yet.
Interesting stuff, because like I said, a lot of your traders over there leaning towards the dark side and also leaning into the weekly, so it is something they could actively adjust and move their trading around accordingly. Well, thank you for that glimpse behind the curtain, Alex, and now we're going to wrap up the old Express block and keep on rolling right on into the strategy block.
The strategy block.
right, and this is, of course, the strategy block, the portion of the program where good old Uncle Mike Tusaw comes down from on high, stone tablets in hand, to dispense some options, wit, and or wisdom. Sometimes both, sometimes one or the other, his choice. Uncle Mike, what do you have in store for our listeners today?
Not by choice. Sometimes it's more wit and less wisdom, and sometimes the opposite.
A little dealer's choice on the old strategy block today.
Absolutely, absolutely. All right, so for today, folks, what I want to go over, since we have an increase in the VIX, I want to go over what Gamma can do as playing a role with your out-of-the-money credit spreads. Now, a lot of people, sometimes they shy away from selling an out-of-the-money credit spread because perhaps volatility is too low. And when you're looking at it, you may feel that with volatility being low, that you have to put your credit spread too close to the current strike price for your comfort level, or if you have your current strike, or if you have your credit spread at an area with which is 5% out of the money, 10% out of the money, whatever, you're not getting enough premium to justify taking on the risk. Now, with the VIX increasing like it has, we may be at a level right now to where it may make sense to start selling out-of-the-money credit spreads if you're fine taking on the risk of the government shutdown. Now, whether you want to do that or not, that's a totally different topic for another strategy block. But what I want to go over today is a phone call that I had from a client last week. And we were just kind of discussing things, and he's a client that I manage a bunch of his money, and he just kind of has another little trading account that he was just wanted to do some credit spreads in with a smaller amount of cash. So we were just kind of going through it, and he has an out-of-the-money put spread on index. And so I talked with him a little bit, and his response was, well, so long as the market stays above this level, then I'm not going to lose any money if it's above this level on expiration. And so we proceeded to then have a half-hour conversation on Gamma. And where I got to was that I encouraged him to have a point of risk management before the market were to get to his short strike price on his put spread. Now, with that, one thing, a general rule that I like to use if I'm ever doing a bull put spread or a bear call spread, let's say that there's a 5-point difference between strikes and I'm getting a $1 credit for it. I'm not a fan of just letting it sit there until it touches the short strike price. Unless I'm combining this with a bunch of other trades, then I might be, but that's a whole other story. But let's just say in and of itself, bare bones bull put spread or bare bones bear call spread, general rule that I personally like to take is that whenever the spread itself is at a loss of $1, that's when I like to get out. Just for the reason that, or usually probably 80 cents, I should say, because then I like to get out as a profit of when I can get a profit of 80 cents. And the reason that I say that is because of the fact that usually when that happens, there's still plenty more room to go until the market touches the short strike price. And so the problem with waiting longer is that when you wait and wait and wait and wait and wait, and the market becomes that close to your short strike price, it's usually too late to manage the risk. Let's say, for example, that XYZ stock is at 50, and we sell the 40-35 bull put spread. I would probably be out, and this is just a ballpark estimate, when the market went down to, say, 44 or 45. And reason being is that between 50 and 45, the gamma that's going to bite you on that short put, it's not going to be so bad. Yeah, it's going to hurt, but it's not going to be that bad. See, gamma has a snowball effect, folks, and the closer you get to the short strike price, the more that gamma is going to work against you and bite you in the butt, quite frankly, if you're short premium. So what I try and do is I see the snowball coming. I like to take action and eliminate the snowball halfway down the hill, because the more that snowball gets down the hill, the more it's going to bite. So what I would encourage you to do is come up with a risk management approach. I met a lot of arrogant condor traders back in 2006. When I was working for Options Express, I would travel from town to town, and I would get a reaction like, why isn't everybody doing the condor? And because it's a different set of people, I'd still hear this at every town I'd go to, but it would be the same story, different town, different person. Why isn't everyone doing the condor? You get a 6% rate of return so long as the market doesn't move 8% in a month or 4% in a month or 7% in a month. It's like an annuity payment. And the way it's set up, you just take the money out, you get the tax treatment if you're doing it on an index. You're just stupid if you don't do it. And I kept telling people, I'm like, okay, I'm not against a credit spread or an iron condor, but don't think for a minute that you're immune to the need for risk management. Because if you feel that you're immune to the need for risk management and trading, well, you're not going to be trading for very long. It's just a matter of time before you blow out your account. And I was very frank with people. Hopefully some of them listened. But with that being said, I would encourage you to look at a high probability credit spread or a condor, whatever you're looking at. Look at it with the same view of risk management as you would with just buying a call or with buying a stock, whatever the case may be. One thing that I think people oftentimes confuse is high probability with guarantee. Sometimes when people hear, oh, it's a high probability trade, so I should make money. High probability does not mean guarantee. So another thing that I do is I like to take a sample of 10, meaning that if I win 10 times in a row, how much money am I going to make? And with that, if I were to make 20 trades, of those 20 trades, how many times am I going to lose? And is that one loss or is that two losses going to wipe out the 18 wins that I have? Look at on a more long-term level instead of having tunnel vision and looking at just, oh, this is a 94% probability trade, so yeah, why am I worried about this at all? If you do that, you're going to be in trouble. And that is one to grow on for today, folks.
I think that's just a unfortunate reality of the options educational world we're in now, where, like we said many times on this show, everyone is just taught the expiration graph. And, your client's a good example of that. Well, if it expires above that, I'm fine. And what do I need to plan for, any other contingencies aside from that? And that's just kind of the way it's done, And you mentioned the iron condor. I have a good story about that. Maybe I'll save it for the mail block here because it kind of pertains to what we're talking about next. But thank you for that, Uncle Mike Tusaw. Excellent strategies as always. And now we're going to keep on rolling right on into the mail block.
Now it's time to empty the mailbag and see what our listeners have to say. It's the mail block.
All right, everybody, welcome to the mail block, my favorite portion of the show, because this is the portion where you guys get to sound off and chime in and let us know what's on your mind, what questions you may have, what comments you may have about the show. We love it all. If you want to join your fellow listeners here, then surf on over to theoptionsinsider.com. You can post a comment on the show notes. You can find us via Twitter, twitter.com/options, facebook.com/theoptionsinsider, or the old-fashioned way, email, which is questions@theoptionsinsider.com. Just be sure to put the name of the show you're writing to in the subject line so we know how to route your question. Today's question comes from a user goes by the handle Destin, and he writes, I know you guys have discussed optimal collar construction in the past. How do you guys decide between that construction versus a more traditional zero-cost construction? That's a good question, Destin. It's actually kind of timely. I was just talking about collars last week at the big All-Stars of Options event they had here in Chicago. We'll get to that maybe a little bit about what Mike was saying about the collars in a minute because it's kind of funny. But what he's referring to, listeners, in case you haven't listened to some of our older shows, our friends over the Options Industry Council have done a bunch of studies on collars in recent years on a variety of different indices, the Russell, the ETFs, gold, all these different things. And what they found when they're looking at collars and measuring the impact of collars, of course, it gets back to managing your time decay like many things in the options world. And, of course, particularly on that long put side of the equation, you have to strike that balance between not paying for an option that essentially is naught but time decay, but also not paying a ton for an option that has 3 years to go and paying way too much for the protection that you're getting and that you need. So what they found in a lot of their studies is that the optimal balance shakes out somewhere around 6 months with a long 6-month put and then a short, very near-term call, either 1 month, or a lot of people opting for weeklies these days. So you're talking long 6-month versus short weekly or short monthly type call. So that's kind of the optimal construction that he's writing about versus the more traditional, which is, of course, finding a put and a call to offset each other in that zero cost mode. I don't know, maybe for me, and I'll go first and let you guys chime in with whatever you want. But for me, I think it depends on my frame of reference. I'm typically not a huge fan of zero cost collars to begin with because they don't maximize that time decay portion that we were just talking about. But of course, not everyone wants or needs a 6-month put with a front month call either. That's a little bit longer term than they're thinking of. So I think for me, if I'm looking at a very, very near term type event that I want to collar against, a zero cost collar can be a good way to go. In fact, ironically, I did just do this recently in my IRA. Ford was trading around 17.5. I had some Ford that had appreciated from about the 9 or 10 handle. I was okay getting out of it at 18, and I wanted to be sure I was out by 17, so I did the old 17, 18 collar for zero cost, and it's worked out well. Ford has dropped quite a bit since then. So I'm not completely averse to zero cost collars. It just really is situational, and I usually find that when people try to force that zero cost collar. When they do that, you end up getting strikes that are suboptimal in order to make that zero cost line up. And that usually means you're in the same expiration month, which again, not ideal from a time decay perspective. But if you have a very near-term event you want to hedge against, and the zero cost collar could be a way to go. Really quick, Uncle Mike, what you were just saying about the iron condors. So I finished my presentation about collars last week, showing some of this data we were just talking about today about collar studies and how the collar can be a more, let's say, more aggressive type tool than you might think of initially when you're trading with collars. And guess, Mike, what the first question I got after that was when someone raised their hand. They wanted to know, can you replicate that with iron condors? That was the exact first question I got.
That is hilarious.
And I just said, really? That's that quick to the iron condors? So yeah, iron condors still the trade du jour for whatever reason. And they want to replicate collars with iron condors. Apples to pears, but c'est la vie. All right, Mr. Tusaw, give us your 2 cents here on collars for our friend Destin.
Love the collar, or the costless collar. If I'm using it as what I like to refer to as a license to be greedy. I have a stock, it's gone my way, and I think it has just a little bit more, but I just don't have the gumption to sell it. Then at that stage, that's when I like the costless collar typically. Now, sounds familiar. And in terms of the time decay, one thing that I like to put and make a point of with the 6-month, 1-month collar that we talk about a lot on this show, option time decay, it's not necessarily linear. I mean, it can be at times, but for the most part, it works in a way with which, let's say you have 100 days till expiration on option number 1, and then 3 days till expiration on option number 2. Well, assuming all factors remain constant, option number 1 is going to lose 1% of its time decay between today and tomorrow. Option number 2 is going to lose 33 1/3% of its time decay between today and tomorrow. Now, that's theoretical. It doesn't always work that way. But the concept is that you're managing time decay when you use that 6-month, 1-month ratio. And that's where the whole benefit comes in to keeping your collar set up to where it's more efficient. And on top of that, as Andrew Giovinazzi would say, you get to do stuff, and that's important.
Gotta love doing stuff. Mr. Sebastian, what's your take here on the zero cost versus quote-unquote optimal collar and when you use each?
I think it kind of depends on how well you know options and what kind of trader you are. The zero cost makes a lot of sense for, it's just like being quarterback, right? If you're Peyton Manning, you can afford to do some optimized collars, but if you're, Kyle Bowler or Matt Flynn or some mediocre or some mediocre quarterback, then maybe the zero cost makes a lot more sense because there's a lot less thought and it puts itself together. So what I would say is you really have to fit the strategy to who you are and know who you are and don't try and be a hero. Do the trade that's best for you.
Yeah, the zero cost is very much a set it and forget it type strategy where the optimal is a lot more management that some people don't like to do. Mr. Alex, take us home on your thoughts on collars here, sir.
So I'm again going to be the contrarian here. Zero cost was not driven by specific market targets. It was driven by people who were fully invested. One point that Mike has made repeatedly and I've reinforced is, and I'll speak for myself here, in a sense, I don't like collars. And it's not that they don't work. It's just that nobody in their heart of hearts wants to sell that call. They just don't want to pay for the put. So if you're doing the collar because you want to pay for the put, then I think you have to look at another strategy. I'm going to look at your example, Mark, where you had Ford in the IRA at 17 and change, and you did the 17-18 collar. And I don't mean to personalize this to you. Why didn't you just sell the stock? And that's the question I always want to ask when somebody brings a collar strategy to me. I know what the OIC studies talk about, but they talk about portfolios that are fully invested versus portfolios that are collared. And I get that the collar is going to outperform. There's some alpha in selling the index call, and you don't eat it all up by buying the index put. But the reality is, if I'm a savvy option trader, what do I want the stock to do after I put a collar on? And by the way, when you ask that question, people kind of scratch their head and look at you and say, well, I'm not really sure. I think there are better ways to take that bite out of the apple. I think the psychology of collars, zero cost is cool. I don't have to spend any money. I get a hedge. But why aren't you simply exiting the position? Tax reasons, transactions costs, dividends. There's something else going on. And you know, in the years I did this, when I would travel, Mike talked about how we traveled. When I would travel, people would come up to me, do what I call Delta speak. And they talk about zero-cost collars. And you say, okay, before you put the collar on, what do you think the stock's going to do in the next 60 or 90 days? And they look at you and scratch their head. And you say, why don't you just sell it? And you say, well, there's tax issues. So you know what? Pick a loser in your portfolio, pair them off, raise some cash. Okay? If I want to do the collar to take me through an event, the end of the year, earnings, something I don't want to sell, endowments who don't want to sell appreciated stock because they don't want to distribute. But ask yourself in your heart of hearts, do you want to sell that call? And the answer 7 or 8 times out of 10 is no, but I don't want to pay for the put. So find something more constructive, blow out of the stock if you're in a non-taxable account, and move to a debit spread. Move to with a better risk reward.
I love it, Mr. Alex. Ever the contrarian here on the show. I like Uncle Mike's reasoning behind it. Sometimes you're not sure if you want to pull the trigger on it, so you let the market dictate for you, particularly in some of those longer term names like in the IRAs and stuff like that, where you might have a little bit more to go, and you might want to capture that. But if it doesn't go that way, you're happy to get out. You know, Ford, a pretty tight example, not probably a name I would usually collar on for just a half a buck, but an interesting example to show sometimes how these strikes can play out when you're doing the zero cost. So interesting stuff. Thank you, Mr. Tusaw, Mr. Sebastian, and of course, Mr. Alex. And that, unfortunately, is about all the time we have for the show today. We could do an around the block, but I think pretty much all of us are just playing wait and see for Washington right now. So that's kind of what we're going to be focusing on. So really quick, let me check in with each of my cohorts, my partners in crime, to see what they have coming up in their respective necks of the woods that may interest you, the listener. Starting off with you, Mr. Sebastian, what is coming up in the land of the pit?
Check your email boxes for a email webinar invite from Option Pit for Andrew Giovinazzi. He's going to be doing a webinar tomorrow at 3:30 Central, 4:30 Eastern. I like to do that time opposite of the way the networks do. You know, so I always like 4:30, 3:30 Central. I like to do 3:30 Central, 4:30 Eastern.
Everyone knows the Mecca is in Chicago.
Yes, of course. So it's going to be on finding trade opportunities, and he's going to kind of show how he scans for directional trades. Should be really good. I'm going to be putting out an email on it, probably a second email tomorrow morning. So keep an eye out for it.
Or check it out, optionpit.com/events if you'd like to learn more. Uncle Mike Tusaw, what is cooking in the land of RCM, and when is the webinar train pulling back into a station near us?
Webinar train will be pulling back in not this week but next week, and I'll have more information for people next week. We have a whole plethora of stops to take us through the end of 2013 and beyond.
And beyond. Wow, Buzz Lightyear coming onto the old network here for the second time in about a week.
Well, who's the first? I thought it was the Minions last time.
It was a different show, but still, listeners will get that joke if the people on this panel will not. And last but certainly not least, Mr. Alex, what is cooking in the land of OX education?
It's a couple events. Wednesday the 9th, Trading Futures webinar in the morning, Idea Hub after the close, and Idea Hub for futures options could go into production this week. But please be aware that you won't be able to see futures stuff unless you have a futures-enabled account. The 10th, Thursday, we're going to do a review of the trading platform and some of the new features. As Mike talked about, we're going to do a Gamma webinar on Thursday. And Saturday the 19th, that's not this Saturday, that's the Saturday after, live events with Jimmy Rouzan, used to be a market maker at Group 1 in lovely San Diego. And all the live
guy
events.
on the planet, too.
He's terrific. He really is.
I love him. He was always one of my favorite people when I was working with at Group 1.
And so he'll be doing the Saturday in San Diego. That's an all-day event. And if you don't want to come out to San Diego, those are simulcast live on the site. You don't need to have an account for any of the events. You can reach the events pre-login. All the events are free. One last thing, the marketing people come by and dope slap me every day. $150 Amazon gift card with any new funded account, $1,000 in funding and 10 trades in 90 days.
Not a bad deal. Put in $1,000, get 15% of it back if you do 10 trades. You can find that over there at optionsexpress.com on the homepage. Just click on the little Amazon gift card symbol, and it'll take you right to it. And on behalf of Mark and Alex and Uncle Mike and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and, of course, for writing in with such great questions. Keep it up. This is going to be a little bit of a hiatus for me. I'm going to be on vacation, so you're not going to hear me on this show for a couple episodes. Some of you may be going, woohoo, right now in your podcast player of choice. I hope not, but we never know. But, of course, I'll leave you in capable hands with everybody else on the old All-Star panel. On Thursday, no show next Monday for Columbus Day, but we'll be back again on Thursday, and then I'll be back again the following Monday. So a lot to look forward to here on the old Option Block program, and we'll see you next time.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting, and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.